If you have $3 million or more sitting in your superannuation, the rules underneath that number changed on the 1st of July, 2026, and the advice you have probably heard for years is now missing a piece. For decades, the standard line has been simple. Keep as much as you can inside super, because the tax rate in there beats almost anything outside it. That used to be true without much argument. It still might be true for you. It is no longer automatic. From the 1st of July 2026, a new measure called Division 296 adds an extra 15% tax on the real income your super earns, meaning the dividends, the rent, the interest, and anything you realize by selling an asset once your balance sits above $3 million. That takes the tax on that slice of income to 30%, and the first year it applies is being measured against your balance on the 30th of June 2027. This is the part almost nobody explains properly. This version of the law does not chase paper gains sitting untouched in your account. That was the original plan, and it got dropped before the bill passed. What is left still costs real money through extra accounting most funds have never needed before, and through tax bills that can land in a lump the year you happen to sell something big. You did everything you were told. You salary sacrificed. You left the money alone. You let it compound for 30 years. Now, right as you are getting close to the finish line, there is a new cost sitting on top of a balance you built the old-fashioned way. Most commentary will tell you super is still the best place for that money, because 30% beats the 47% top rate outside it. What that comparison usually leaves out is the $2,000 to $5,000 a year in extra compliance some funds now carry, and the fact that Treasury estimates only about 90,000 Australians, roughly 0.5% of everyone with super, are affected right now. Today I want to walk you through the real math behind the $3 million line, why the gap between 30% and 47% might be smaller than it looks once you add up what it costs to stay compliant, and the liquidity test worth running before you decide whether to leave a high balance inside the system at all. If you are sitting on a high balance and starting to feel like your retirement fund has become something the government reaches into whenever it needs to, you are in the right place. I am Bob, and on this channel, we do the arithmetic most explainers skip. This is the mechanism most headlines skip. Division 296 does not tax your whole balance, and since the final version of the law passed, it does not tax paper gains either. It taxes the real income your fund earns, meaning dividends, rent, interest, and any capital gain you actually realize by selling something, worked out as a percentage of your total balance. If a quarter of your balance sits above $3 million roughly, a quarter of that realized income gets hit with the extra 15%. I have watched this happen to people who spent decades doing exactly what they were told, only to watch the finish line shift right as they reached it. That frustration is real, and it has nothing to do with being greedy. That sounds almost reasonable until you see how lumpy realized income can get. Say your SMSF holds $4 million, and in a normal year it earns $120,000 in dividends, rent, and interest. With a quarter of the fund above the threshold, about $30,000 of that counts as taxable under Division 296, and the extra tax comes to roughly $4,500. Add the accounting work, most SMSFs now need to track this properly, often another $3,500 a year, and the real cost of sitting above the line runs close to $8,000 in an ordinary year. An ordinary year is not the problem. The problem is the year you are not expecting, the one where the fund sells a big parcel of shares to rebalance, or sells a property it has held for a decade, and realizes a large capital gain all at once. That gain gets added to the same pool, taxed the same way, in the same 12 months, whether or not the timing suits you. Most people who cross $3 million got there slowly, through decades of contributions and compounding, on money that was already taxed going in. The frustration is not about the number attached to the balance. It is about a fund now paying an extra layer of tax on income it always would have earned anyway, at exactly the moment that income shows up. There is a trade worth naming plainly. Staying inside super still means a lower headline tax rate than almost anywhere else. But every dollar spent proving what counts as realized income above the line is a dollar that was not part of the plan 5 years ago. And for balances only just over $3 million, that dollar can matter more than the extra tax itself. That $8,000 a year is not the part that should worry you most. The bigger risk shows up the year your fund has to sell something large, whether it wants to or not, and the tax bill that follows lands on a timetable you did not choose. That is where this trap actually bites, and it is what we need to unpack next. For years, I told almost every client the same thing. Keep it in super, because the tax rate wins every time. I was not wrong about the rate. I was wrong to stop the analysis there. There is a better way to measure this. One number I call the net utility score. Take what you save in tax, then subtract the compliance cost of managing a fund near or above $3 million. Then subtract what I call the liquidity risk, meaning how easily you could actually get at that money if a tax bill or a big expense landed in the same year. The tax rate alone was never the whole picture. It just used to be close enough not to matter. Picture a $4 million SMSF, where most of the value sits in one commercial property, with the rest in shares. The rent is realized income every year, so Division 296 applies to the portion of it tied to the balance above $3 million, and that part is simple enough. The risk shows up if the fund ever needs to sell the property itself, say to fund a member's pension payments. A single sale can realize a capital gain worth years of ordinary rent in one hit, and the tax bill on that gain arrives the year the property changes hands, whether the timing is convenient or not. Think of it like being asset-rich and cash-poor, the way some retirees feel staring at a council rates notice while most of their wealth sits locked inside the family home. The property is real, the value is real, but none of it pays the bill sitting on the kitchen table this quarter. Now picture the same $4 million held partly outside super in a private structure such as a family trust. You will hand over more tax along the way on ordinary income. There is no way around that. But you decide when assets get sold, which means you decide when a capital gain shows up on anyone's tax return. That is the trade most people never get shown, because most conversations about super stop at the headline tax rate and never get to control. There is one more wrinkle worth knowing before you make any decision. Division 296 is assessed against each person's own total super balance, not a household total. A couple who split $4 million evenly, at $2 million each, sit under the $3 million line individually and pay no Division 296 tax on that money at all. A single person holding the same $4 million in one name has $1 million exposed above the threshold and pays the extra tax on the realized income tied to that portion. Same household wealth, same market conditions, and two very different outcomes, purely based on how many names are on the accounts. Think about what that means if you are the one holding the balance alone, whether by choice or because you are widowed, divorced, or simply never had a partner with super of their own to split against. The rules were not written with you specifically in mind, and that is worth knowing rather than discovering later. None of this is an argument to panic or to empty your fund tomorrow. It is an argument to actually run the numbers for your situation instead of trusting a rule of thumb that was written for a world where this threshold did not exist. And once you have run them, there is still one test left, because everything you just heard assumes a calm, ordinary year. Markets rarely cooperate on schedule. Let's put the $3 million line in perspective. According to ASFA, a couple needs roughly $690,000 saved by 67 to fund what it calls a comfortable retirement. $3 million is more than 4 times that figure, which is exactly why this measure was framed as something that would only ever touch a small, clearly wealthy group. Right now, that is roughly true. Treasury estimates around 90,000 Australians are affected, about 0.5% of everyone with super. This is the part worth sitting with. The $3 million threshold is indexed, moving up in $150,000 steps tied to inflation. That sounds like protection against exactly the problem I am about to describe. But indexation only tracks the cost of living. It does not track how fast a well-run super fund actually grows. Over the long run, a diversified super fund has tended to earn something closer to 7% a year, well ahead of the 2.5% to 3% inflation that drives the threshold's own steps upward. Run those two lines side by side for 20 years, and the gap between them does not close. It widens. A fund that started well under $3 million can cross that line through nothing more than ordinary compounding, while the threshold itself has only crept up in modest, delayed steps behind it. Take a fund sitting at $2,200,000 today. Growing at 7% a year, it passes $3 million in a little over 5 years, comfortably inside the working life of anyone reading this in their late 50s. Even if the threshold nudges up by $150,000 along the way, the fund's own growth is moving roughly 3 times faster. That is not a warning about being reckless with money. It is simply what happens when one line moves with prices and the other moves with markets. This is not a new trick in the tax system. Bracket creep works the same way for everyday income tax, where the thresholds move slowly while wages rise faster, and more of your pay drifts into a higher bracket without your income actually going further. The Australian Bureau of Statistics tracks that drift every quarter through the Consumer Price Index, and the same underlying math applies here. A fixed dollar figure, or even a slowly indexed one, never stays a fixed target once growth is in the room. That is the quiet shift worth watching. A measure built to catch a small number of very large balances is, by simple arithmetic, on a slow path toward catching a wider group of long career savers who did nothing unusual at all. Whether policy catches up with that gap before it reaches you is a question worth watching over the coming years, not a reason to make a decision today. Meet John. He is 64, running an SMSF worth $3,500,000 split, mostly between Australian blue-chip shares and one regional warehouse he has owned for years. Midway through the financial year, John's accountant recommends trimming some concentrated stock positions, selling a parcel of shares he has held since before the SMSF existed. It is a sensible portfolio move. It also realizes a capital gain of $260,000 in a single year, on top of the fund's usual dividends and rent. Because roughly a third of John's balance sits above $3 million a slice of that realized gain, along with the fund's ordinary income, gets caught by Division 296. The bill comes to close to $18,000, arriving once the assessment against his balance is finalized. Around the same time, the tenant in his warehouse gives notice and moves out, and John's cash flow tightens right when the tax office wants payment. Now picture the version of John who saw this coming. Before the sale, he used what is sometimes called the equalization lever, moving contributions and withdrawals between himself and his spouse, so no single balance drifted too far past the shared thresholds. He also spread the sale of that share parcel across 2 financial years instead of 1, so no single year carried the full weight of the realized gain, and used a withdrawal and reinvest strategy to hold his own super balance closer to the transfer balance cap of $2,100,000, moving the rest into a separate structure outside super. Outside super, he still pays tax on that money, and it is not a free ride. But he decides when to sell, which means he decides which year carries the bill. When a big sale is coming, that difference decides whether the tax bill is one you planned for or one that shows up alongside a tenant giving notice. It is worth asking yourself here whether your own fund would survive a year like that. Not a crash, the opposite, a genuinely good year, the kind where an advisor tells you it is finally time to sell. If a single large transaction could push a meaningful slice of realized gain through your fund in 1 year, a strong result can create the exact same squeeze John found himself in, just with different numbers attached. That gap between a planned bill and a surprise one is rarely about the size of the tax. It is about whether you had 6 months of notice or 6 days. If one of you is sitting on $4 million in super, while the other has $1 million, that gap alone can be costing real money in extra Division 296 tax once realized income starts flowing, contribution splitting, or a withdrawal and recontribution strategy where you are eligible, can move the balance closer to even between two members, so more of the combined fund sits under each person's own $3 million line instead of stacked on one side. For SMSFs, there is also a single cost base reset election available for assets held before the new rules began. Used correctly, it resets what the Australian Taxation Office treats as your starting point for capital gains tax. On an asset carrying a $500,000 unrealized gain going into the new rules, a properly executed reset can be the difference between reporting that full amount as a realized gain later and reporting only the growth from today forward. And on a future sale, that difference can be worth tens of thousands of dollars in Division 296 tax alone. Then there is what I call the friction point, sitting roughly between $3 million and $3,200,000. In that narrow band, the extra accounting and reporting cost of tracking Division 296 properly can run close to what the tax itself would collect. For balances stuck in that dead zone, it is often simpler to withdraw the excess and park it somewhere plain, a high-interest offset account or an ordinary brokerage account, rather than pay for the privilege of staying just above the line. None of these three moves require guessing. They require running your own numbers, ideally with an accountant who has actually worked through a Division 296 assessment, not just read about one. So why do so many people who understand all of this still leave the money exactly where it is? It has very little to do with the math. The honest answer comes down to loss aversion. Paying 47% tax outside super feels like such a loss that a lot of people fixate on the 17-point gap down to 30% inside super and stop the comparison right there, even when compliance costs and a badly timed tax bill can erode a real chunk of that gap in practice. That reaction makes complete sense. For 30 years, super was sold to you as the gold standard, the safest, smartest place for retirement money to sit. Pulling money out of it can feel like admitting you got something wrong, even when the rules underneath it changed, not you. I have seen people delay this decision for years, not because the math was unclear, but because it felt like giving up on something they had been told was sacred. So try asking a different question than the one you have been trained to ask. Instead of where is the lowest tax rate, ask where you would have the most control if life changed direction tomorrow. A health scare, a spouse who needs care, a grandchild who needs help with a deposit. Control over timing, not the tax rate alone, is what actually protects you at this stage of life. That is not a criticism of anyone who has stayed put. It is simply the next question worth asking, calmly, before the next assessment arrives instead of after. Division 296 is not a reason to panic. It is a reason to actually audit where you stand. If your balance is above $3 million, the old rule that super always wins is no longer automatically true. It is now a case-by-case question of liquidity against tax, and the only way to answer it is to run your own numbers before the 30th of June each year, not after. I am Bob, and this is Aussie Retirement. If this helped make sense of what is actually happening to balances like yours, stay subscribed, because we will keep doing the arithmetic. Instead of just repeating the headline, do not let a threshold You cannot control quietly turn the nest egg you built into a liability you did not see coming.